Hello, welcome to the Real Estate Players Podcast. I'm Joe Pizzuro with Break Chain Capital Investments.
Hey, and I'm James Wilson with Old Capital. Today's show is about real estate players doing deals in the real estate industry. And we have a guest, someone that I've looked up to since I joined Multifamily, a very successful syndicator, Dustin Miles. How you doing?
Good, good. Yeah, excited to be here. I just got out of the cold plunge, so I'm still a little cold.
That's the secret right there.
Yeah. So,
Yeah, so tell us about your background, like how you got started in multifamily, and yeah, we'll just go through some stuff that's going on in the current market.
yeah, feel kind of similar to a lot of people in the space. I was a former engineer for a defense contractor and went to school for engineering and all that stuff. And kind of got into single family, I don't know, like 15 years ago or so, 15, 17 years ago. I think I was trying 17 years ago and then actually landed my first rental about 15. But kind of, got into that, did about half a dozen rentals and flips, and then I was like, okay, this is cool. How do I scale this? And so I kind of looked around and didn't see a whole lot of people, honestly, that had been able to scale past a few handful of rentals. I'm like, well, this is great. This is, more like a hobby. And I wanted to be able to scale. And so naturally looked at multifamily. Kind of, I like to dip my toes in the water and all that. And so I'd hired gone through some mentoring programs and hired a coach and all that good stuff. So but yeah, kind of at a high level, that's how I got started.
Awesome. So how many deals do you think approximately that you've done over the years?
Where I'm kind of the lead or co-lead or whatever, 17.
Oh, that's great.
Oh, yeah, that's good.
Good track record over the years. And Houston's kind of the market that you've done a lot of deals in, I've noticed, right? Are you still in Houston looking for deals? Are you branching out? What markets do you kind of like these days?
Yeah, we like Houston quite a bit. We just kind of know you. I think you really, people that are outside of Houston and try to buy in Houston, I think unless you really know Houston, that could be very, very challenging. And so I think we've seen some people that, if you don't have your operations in line and you're not, you're asleep at the wheel, so to speak, I think you can get into trouble, pretty quickly. And that's kind of, honestly kind of anywhere. But yeah, we like Houston quite a bit. We're seeing more competition on stuff, probably after, probably starting Q2 of this year. I felt like for a year it was basically us versus us. And so it was great because we could, we had soft terms and all that stuff going into deals. I live in DFW. I live in Fort Worth, and so we think it's a really good time to buy in the DFW area. We bought a deal earlier this year in Houston, and we were real close on some stuff in DFW, and we really wanted to. So we feel our next deal or few deals will be in DFW, but it's hard because we have a pretty good track record down there, and so we get shown a lot of stuff in Houston. And honestly, even though I've been doing this for a little while, I kind of feel like, I mean, I have, the brokers kind of listen, but it's kind of, they're like, we haven't made any money for them lately. So it's interesting. I'm so having to kind of build build that rapport and build up the track record up here. And a lot of people, it's one thing to be friends, but it's another to, or to be friendly or whatever, but it's another to can you actually perform? And we just haven't bought a deal up here in a while. So that's a pretty interesting, but I've known these guys for, a decade now. So it's interesting, yeah, time right now, but we're excited to get into DFW and expand up here.
What is your favorite submarket in DFW, if you had to pick one?
Um, I really like HEB. I feel like it's a good, just kind of good bang for the buck. Just good value, good schools, not not too terribly expensive. I also like that it's somewhat kind of landlocked a little bit. There's not tons of land to go build either. So, those are, kind of, I don't know, pretty much all of North Dallas is really nice. North Fort Worth, I know the Tarrant County side a little bit better. But North Fort Worth is great, but the problem is they're building a lot there, and so you could, could it come into some concession battles, or just depends on the vintage of property that we're buying. So.
What do you think's
Yeah, I
the
like.
what's your strategy, I guess? Is it cost basis you're looking at? Is it value add potential or a combination of all of the above?
Yeah, in a perfect world, we'd love an awesome basis and we'd love an awesome, going in cap rate. Normally you can't have your cake and eat it too. So, we, you know, we like the basis. That's kind of more, more of the focus. So, if the basis feels good, and we're really, we're very, very cautious about the areas that we buy in. Um, so we're, very, yeah, just kind of cautious there. And then in DFW, we're looking at 80s newer product, just well located. And then down Houston, it's 90s and newer. Kind of preference is 2000 and newer, kind of all in the burbs, all, north and west. And we want to be, as far as, away from the coast as possible down Houston.
Yeah, I've been tracking the deals in DFW kind of for several years now, and it seems like a majority of those like solid 80s deals, they got picked up in like the 21, 22 bridge loan boom. So they're kind of like locked up right now. But I feel like in the next couple of years, a lot of those deals will be coming out to the market, and there'll be a lot of opportunity for people like yourself and other people that like to invest in DFW. I think there's going to be a lot more market activity.
Yeah, yeah, that's what it looks like, and there's some stuff that's trading. And it seems like it's been picking up steam for sure.
Yeah. You want to talk about like a deal story that you've done recently? Recent deal you worked on, like any challenges that you came across? Obviously, raising capital is tough these days, but anything
Yeah.
else in particular?
Yeah, it always feels like you get into a deal and you're like, "Oh, this is going pretty well," and then you get sucker punched.
Yeah.
So, yeah, there's a deal that we closed late last year. It was a pretty big deal, for us, and just raising capital is just, pretty challenging, but the total raise was, around 20 million or so. And it's a new deal. There was a distressed seller. They had to sell, and we were buying below where they bought at, by quite a bit. So, and then as far as the comps and all that, we bought, pretty significantly below, a lot of the comps and what it would cost to build. So, that deal, we thought, we don't like to retrade it at all. And so anyways, but we had a real difficult time finding capital for that deal. And so we went back to the seller and we're like, hey, we just closed a deal, this, similar size deal a few months ago. We're having a really tough time just to go in and like the basis is awesome. To go in and cap rate's terrible. And we're getting major pushback on that, from equity just kind of in general. And so we were like, we don't like the assets, but like we're going to need a discount and we're going to need a reduction. And so we ended up with, nearly a $5 million reduction, which is obviously, it's 40 something $1 million deal, but I mean, it's a pretty significant price reduction. And as soon as we got that price reduction, all the equity came in
Yeah,
almost
even better
instantly.
basis.
I remember
Yeah,
you telling
yeah.
us about that, like Thanksgiving last year. Was that the time?
Yeah, yeah, it's probably the worst time to raise capital. So, it was during the holidays, which is it's always it's so tough to rate. We closed a few days before Christmas. I think the 21st is when we closed. Which don't like to cut it that close. So,
The
but
winter
it's
solstice.
yeah, it's so hard raising capital around it because you just have so many holidays and hey, Mr. Investor, put down the turkey like I got a deal for you. Like that doesn't, no one, everybody's turning stuff off the week of Thanksgiving, and then it's just everything is super, super slow. So, um, but
Yeah,
we got the price reduction and we got it done. And I mean, we're sub, 150K a door for, 2019 product. So.
yeah, I don't think it helped either that last year was just kind of a bad year in general. Like there was no activity, people weren't going out really looking at stuff, just kind of on the sidelines.
Yeah, I think the price reduction helped us, and then it being an end of year close because people were looking for depreciation, even though they didn't have, it's not like they had sales or anything to really have to offset. It was just, offsetting income. So
Yeah. And it was 80% last year, right? And this year it's 60.
yeah, I think so.
Yeah.
Dustin, do you have your own in-house CapEx and property management, or how do you guys uh, do that? Do you outsource?
Yeah, we do outsource that, outsource the third party. We think we're probably more of a hybrid. Like we don't just and frankly, this is what, when I first started out, kind of, 2013, 2014, because rents were going up and everything was, you throw, two-tone paint and vinyl flooring, and then you charge $150 more a month. I mean, you could just hand stuff over to a third-party management company, and not just go on vacation, but I mean, it was a lot more hands off, and I feel like now, I mean, and we're in a lot nicer product than I was when I started, but yeah, we have third party. There's a lot of accountability the that's involved. The managers have to fill out, we call it a WMR. They have to fill that out weekly before they meet with us. And then we're at the properties each and every week. Sometimes we tell them we're coming, sometimes we don't. And then there's just a lot of accountability that's kind of we try to design it to where the you don't want to be overbearing, but we try to design it so it's very difficult to get off the rails. And honestly, we kind of designed it to where in our to where, it doesn't really matter what management company we're with. We can just plug in our system and then roll. So, but we have like because we have a decent sized portfolios. We have dedicated accountant, dedicated, regional, and so they're only focused on our assets, and so we have a lot of attention, and so it's kind of like we have a management company
Yeah.
within a larger. There are, I know a lot of people, tout the, oh, we're vertically integrated, but it's like, they don't, no one talks about how people were vertically integrated and then the lender kicked them out and then they had to go hire RPM. So, and like if they're doing a crappy job, like they're not going to fire themselves. So
Yeah.
there's pros and cons to everything. We work with Asset Living. They're one of the largest management companies in the country. They have a huge footprint. And so if we need a leasing agent, if we need anybody on the maintenance side or a new manager or something like that, we can kind of they're able to put something out there to where we could potentially pull someone from another property. Um, and so there's pros and cons to everything, but where they have a lot of resources and I think that is able to help us out quite a bit. So.
What are
That's
some of your goals for the future that, like the next 5 years?
Yep. We are so we've just kind of been putting our systems are pretty well defined right now. A lot of it's going to be just kind of plugging new people in to kind of help out, help us grow and all that. We've been telling ourselves like, oh, we're going to do 4 deals a year, and we've been doing, 2 deals a year. We're probably only going to do one this year. And so we're kind of gearing up to be able to, and we just brought on some new team members, and so we're kind of gearing up to. We'd like to do four next year if possible. Capitals, is a real challenge, and that's one thing that's kind of been holding us back for sure. But yeah, we'd like to grow to four per year, basically a deal a quarter, maybe and maybe as the next few years progress, kind of build that up. But we'd love to have we have a little under 1,600 doors in Houston. So we'd love to continue to build that up. And then we'd love to have a similar portfolio in DFW. I don't know. Um, we would not move to another metro. San Antonio, Austin would be kind of the next natural fit. We wouldn't feel comfortable going there until we have DFW kind of built up first. So, but kind of building up DFW and then potentially looking at Houston, or I'm sorry, San Antonio, Austin, or I don't know. We may just end up hey, we have two of the largest metros in the
With that.
country and with tons of apartments. Maybe we just stick with those two. So.
nice. So when you buy the deals, like what kind of loans do you like using? How do you like structuring them?
Well, we've we've done a lot of bridge loans with caps. Kind of getting tired of buying caps and kind of getting tired of getting beat up on that end.
Yeah.
So the last deal we did, we just did a Freddie Mac loan. It was a for us, it was a small enough, raise and all that. It wasn't too big of a deal. And so, but we did have quite a bit of CapEx that is going into the property. We're spending over $22,000 a door there, for a 90s product. And so, um, the benefit of that Freddie Mac loan is we control the CapEx dollars. And, for instance, we've had some, things in the past with lenders, whereas, if we say we're doing a backsplash and we're doing this countertop, and but we get into it and we're like, let's do this countertop at the backsplash, let's nix it out. They some depends on the lender, but sometimes they require us because it's, part of the loan. We have to put in the backsplash even though it's not really doing anything for anybody. So we like the flexibility there, and then obviously not having to deal with the rate cap and all that. Is, everybody's kind of been beat up on that the last few years, so it's nice. In moving forward, I mean, we're not opposed to bridge loans and putting a cap on there, but we just, especially this past deal was small enough. It's like, let's just, we just wanted to, kind of diversify our lending and again have flexibility on the capex side.
Yeah, you've been in the business quite a while. Didn't they used to have like Freddie Mac and Fannie Mae? They used to have actual CapEx financing, right?
Future
Yeah,
fund, they
yeah,
call it. Future
yeah,
funding.
And not anymore.
yeah, yeah. So.
We got a couple minutes left. What, if you wanted to tell the viewers anything, what, how to get a hold of you, or what would you like your message to be?
Um, Yeah, I think well, I guess two things I'd say just, prior to that would be for your audience, if you're a passive investor, I would say just kind of be, or if you're an aspiring syndicator, I would say just be patient. And multifamilies, going to be around. There's always going to be deals coming up. So I would just be patient and focus on location. I know it's old adage for single family. I think it very much applies to multifamily as well, because you can put all this money into a property, but you can't change your neighbors, can't change your zip codes, can't change your schools. You can say, oh, I'm raising it from a B to a C, but I'm sorry, from a C to a B, but if you're in a C neighborhood, it doesn't, anyways, you're still gonna have, C tenants. And then as far as getting a hold of me, happy to chat with anybody. Our website's just momentummultifamily.com. I'm on LinkedIn and Instagram and all that stuff's just Dustin Miles. So appreciate you guys having me.
Yeah.
Awesome.
Thanks for
Enjoyed it.
coming on.
Yeah.
All right. That's the
Everyone.
show. We'll catch you on the next one.